Okay, so good morning, everyone. Welcome to today's macro snapshot. We are Wednesday, April the 30th, so it's the end of the month, so there could be some sort of flows and unusual activity. What we do have today, we had a fairly quiet overnight session, but what we do have is a very busy data sort of morning with a lot of quite important stuff. So let's just first of all review that. What we have at 8:15 coming up in about 45 minutes. I'm recording this about 7:30. We have ADP employment. Now, we know that that's not perfectly correlated with the non-farm payrolls number. However, it is part of the mix, and that's expected to be sort of coming in on the low side at 115,000 compared to last time, 155. And I think the way to look at everything, just in terms of the data, just stepping back, the bigger picture is that the surveys have been weak and indicate that there is sort of more and more pressure coming into various sectors, like sort of demand for services and spending and whatnot. Having said that, the real data, what people are actually doing, is still pretty robust, and the real data is still quite strong. So there's kind of we say in French, a décalage. There's like a sort of a gap between the two here, and really the big question which the market wants to answer, like the answer to the puzzle here is, is the survey data, will that be reflected in hard data in kind of May, June, and will we get some maybe slowdown or even recession in the US? Or is the survey data just sentiment and people kind of getting a bit nervous because of Trump's unsystematic approach to sort of to policy? We shall see. So the thing is, what we have to look at today, a lot of the data is some of it is backward looking and some of it is survey. So the question is, will the market sort of look at it as an agglomerate, as in a kind of a combination and say, well, hey, things are not trending in the right direction? Or will the market be, a bit more sanguine and shake it off and say, well, it's all sort of backward looking, or it's just surveys? It's going to be quite interesting. Because definitely in the last few days, we've seen the markets go into very small ranges and just very choppy sort of, range-bound price action. Of course, what we do have this afternoon after the bell, we have Microsoft and Meta. So we're starting to get some of those tech heavyweights. And again, we get a couple more tomorrow. So will that also sort of drive that story that maybe tech on a global stage will outperform sort of smaller domestic US companies? That's also going to be quite interesting. Anyway, so we have the first part of the employment puzzle today. We have ADP. Let's see what happens there. But then at 8:30, we start to really ramp up. We have the first reading of the first quarter GDP. So again, this is the GDP from January, February, March. Not including, obviously, when Trump announced his tariffs on April the 2nd. So in one sense, you could say that this data is sort of less relevant and backward looking. And it is backward looking because, it literally goes up to March. So just from a sort of a calendar perspective, this is backward looking. On the other hand, there's another sort of school of thought, which basically says that even if you leave aside Trump's tariff announcements, the US economy was basically sort of starting to slow down just because we still have a restrictive Fed. So remember the Fed funds rate, the effective Fed funds rate is still at 4.33. So we have a restrictive Fed. We had an employment situation which was somewhat softening, and we had, basically a US administration which was looking to cut costs, cut deficit spending, cut sort of government workers, and generally be less fiscally stimulative. So the point about this is to say that even apart from all the tariff nonsense and shenanigans and confusion, there's some sort of evidence. There is a little bit of evidence that the U.S. economy was starting to slow, sort of November, December, January, February. So the point is that maybe this GDP data, let's see if it's what it's expected to be. And as you can see here, it's expected to actually be minus 0.2. So that's sort of pretty low. So it's going to be interesting to see if that's a shock. I don't know if it comes in at -1 or -2, or indeed, who knows if it comes in positive. So definitely be looking at that for that one. For me, what's always kind of interesting is the personal consumption numbers. And again, you might want to put that together in terms of an ensemble of data. At 10 o'clock, we have personal income and personal spending. So I think it's important here in terms of the spending and the consumption, just to see if the U.S. consumer is still happily spending, even if they're sort of complaining in sentiment sort of surveys. Uh, what, of course, is going to be quite interesting also for the Fed in terms of inflation is the employment cost index, which is a quarterly number. So that's quite an important one. That's expected to be stable at 0.9. Again, this is important because one of the sort of the tensions of the Fed is that if inflation remains sticky, it's going to be harder for them to cut aggressively, in theory anyway, if the economy starts to slow down. So I think the market will look at this employment cost index through the prism of saying, well, if at least if inflation seems to be moderating, which seems to be the case, for example, over in Europe, and maybe we saw the numbers overnight from Australia, that will give the Fed a more cover or make it easier for the Fed to cut more aggressively. So that's kind of interesting. So let's definitely keep an eye also at 8:30 on the employment cost index. We have the Chicago PMIs. Now, some of the other sort of regional PMIs, we saw Dallas recently and Philly have been very, very weak. So interesting to see if this number of 45.9, which is in contraction territory. Remember, below 50, it indicates sort of a negative contractionary kind of reading. So let's see what's going on there. And then, of course, real personal spending. Well, that's kind of personal spending, but the real personal spending, obviously, adjusted for inflation. So that's important. So a lot of important numbers. And then, of course, at 10 o'clock, we also get the PCE. Again, no need to remind everyone that that is the Fed's preferred gauge of inflation. So at this point, if you look at the sort of year-over-year number, the core, which is technically the most important number for the Fed, 2.6. So that's expected. Whoops, that's expected to attenuate, so to come down from 2.8 last time. So 2.6 is still too high. Remember, their a sensible target is 2%. But hey, 2.8, 2.6. If that starts to get down, let's say under 2.5, that's going to make the Fed a lot more comfortable, and also, in theory, will allow them, as I just said, potentially more flexibility in cutting rates aggressively if needs be. We shall see. So a lot of data there, and I think the way to look at all of this is. We can look at a few different markets and see what's going on. The stock market has been pretty sleepy, to be absolutely honest. You look at VIX here, the VIX has come down quite a lot, ticking up a little bit this morning. And just to put that in perspective, just in terms of the volatility, we haven't looked at that for a few days. Let's just have a look. I just put up the futures curve, and you see in the VIX, that is the oil curve. So it's the VIX futures. So you can see here that although the VIX spot has come down a lot, from very, very, very elevated levels, we're still talking at about, 24 and a half here, which is, for sure not where it was at 30, 35, 40. But this historically is still relatively elevated, is still quite elevated. And, just from a mathematical perspective, a reading of 24 indicates about a 1.5% move every day on the SP 500. So it's still quite elevated. And as you can see, maybe even more importantly, is that the shape of the curve, it's still in a backwardated structure. So we have the spot, which is above the first future, above the second, above the third. So it's still indicating that there's quite a lot of immediate tension, so to speak. Now, if we go back like to the maximum, I just want to sort of put this in a bit of perspective here. If we go back, I think it was April the 8th, where we had the most. So the point is that this is where we are now. So it's not nearly as dramatic as it was. This is like in peak sort of post Trump tariff announcement kind of pain, where you see the VIX spot was up at about 52 or so, and a very, very strong backwardated curve. But the point is, this is still quite elevated. And just to give a bit of perspective there again, if we go, I don't know, I'm just going to put in a random thing. 6 months ago, let's see what we get. I mean, it could be the wrong one, but you see what I'm talking about, the shape of the curve, very sort of flat 6 months ago, and obviously the spot price itself down a lot lower. So the point is that VIX is, sort of better in the sense that it's less dramatic, but the point is that it's still elevated. So let me just get rid of this one there. Yeah. So now what that means is that the SP 500 hasn't been doing much and basically has just been trading within a range. So if you look at the SP 500, so we'll just look at the ES futures here, you can see they've been grinding up a little bit. There was a bit of news sort of, yesterday afternoon from Trump, essentially alleviating some of the tariffs on parts, so parts for automobiles. That was received as a positive. There's been the usual rumors from the Secretary, what is it, of Commerce, Lutnick, Howard Lutnick, saying that a deals are going to be announced quite soon on certain countries. So there is a little bit of positive rhetoric coming out of the White House, but I think the market is quite skeptical at this point. The market really wants to see concrete sort of numbers. The other thing as well is, for example, I was reading just this morning, the South Koreans saying that it's a complex negotiation. It's going to take weeks and weeks, if not months. So I think the point is that there's got to be this bifurcated sort of communication that the reality of countries is that this is going to take weeks and weeks, as I say, if not months, to actually do the nitty-gritty of trade deals, whereas the Trump administration is constantly trying to be pumping things. So that's why I think it's difficult for the market to really rip much higher. And it also just wants to see, is the GDP sort of slowing down? Is inflation under control? What is the situation with the labor market? And we're also going to be getting these sort of tech earnings. So I think there's going to be a bit of a make or break here. If we get a series of positive news, now what would positive news look like? I think we're going to have strong tech earnings. We would have strong guidance. We would have employment looking quite solid, maybe not super strong, in fact, just like sort of in the middle solid. We'd maybe have inflation coming down a little bit, or at least not particularly sticky, and we would have a GDP which is solid. If all of those sort of coexist, so to speak, we could have the equities pushing up. On the other hand, if we get a confluence of sort of negative data, so that would be high inflation, a dramatically lower GDP, an employment situation with ADP, which was sort of much lower than expected, maybe a high employment cost index, maybe all of that would be enough to kind of, basically for the stocks to say, hey, we don't want to fill this gap between the Liberation Day, the announcement of tariffs, and maybe could push it down. That, of course, would lead to a spike in the VIX, and of course, it would become a bit of a self-fulfilling prophecy there. We shall see. The other thing which is very, very important this morning at 8:30, we have the quarterly refunding. We have all the details for the quarterly refunding. So just to remind ourselves, the quarterly refunding is essentially the where the sizes of the auctions are announced, and essentially how much debt the US government will need to sell to cover its bills. So I think the things which we should look at, we already had a bit of a pre-announcement on Monday afternoon. Nothing particularly dramatic there. As you guys can see here, if we look at the 30-year yield as especially for the long end, it's kind of sensitive. We can see that the 30-year yield has actually come down a lot, and we're now looking about 4.6. We can see that. I just want to throw a quick fib on here just to see where we're at. So we're getting to an interesting point here that there could be a little bit of resistance down here at the 61.8% fib. But really what I'll be looking at the quarterly refunding announcement is there any sense that there will be lowering, so less coupons? And coupons is generally understood to be the longer end of the curve, so 10-year and 30-year. Will the US government feel the need, Scott Bessent, the Treasury Secretary, to issue more coupons? That would be very, very bad for the long end of the curve, and would see the yields ripping much higher. That would lead to a long end led bear steepener, which is not going to be good for equities. On the other hand, of course, there could be the possibility of less coupons. Now, remember that Bessent has said a lot, as has Trump, that they want the 10-year yield down. They're very obsessed about reducing the 10-year yield. And so one way to do that would be to reduce the number of long end bonds or coupons being sold. So if that were to be the case today, that could be actually a positive for the long end of the curve. And we could see these yields coming down on the 10-year and on the 30-year. And that would be sort of a long end led sort of bull flattener, basically. And that would be a positive for stocks. That could be a big positive for stocks today. So definitely keep an eye on that. Now, how will they sort of fund that if they're actually going to be sort of issuing less long end coupons? They could decide to fund that with short dated bills. So what we could see here is some kind of twist operation that they issue more front end bills, which can be more easily absorbed by the market, and those bills would basically will sort of offset the coupons. The second thing they might do here is I would have to keep a lookout for the auction sizes, of course. But the other thing which is interesting, which I think I mentioned the other day, was buybacks. So this idea that the less liquid sort of off the run bonds. So that, for example, I think I gave the example the other day. So let's imagine like a 10-year bond, which was issued 7 or 8 years ago. Its real duration at this point is, let's say, 2 years or 3 years. And the problem is because it's less liquid and essentially never trades in the secondary market, that off the run bond, basically there's a premium for illiquidity, sort of lack of liquidity, and the yield of that is a little bit higher than the equivalent freshly issued, let's say, 2-year bond. And the US Treasury doesn't like that. So we could find ourselves in a situation where they want to sort of suck up and sort of buy back from the secondary market a lot of these sort of illiquid, non-trading, off-the-run bonds. And to do that, they might actually pay for that because actually the money has to come from somewhere. They might actually issue a bunch of front-end bills. So all that to say that the front end today could be under a little bit of pressure because there could be more issuance from the front end, and it could actually be a positive for the back end. Now, if we do get that positive thing for the back end, so lower coupons or quite significant buybacks of the long end bonds. As I say, that could be a positive also for the stock market and for risk assets in general, because that would be considered by the market sort of quite a significant influx of liquidity overall. So I think we could see a stock rally as well. So that's something kind of interesting and a little bit technical. At 8:30 is the quarterly refunding announcement. So try and sort of figure all of that out. In terms of other stuff, what's interesting is that just keep in mind that China is about to close or has closed for like a sort of a 4 or 5 day holiday. I think it's Labor Day over there, so kind of a big national holiday. A lot of the markets are closed. And just in terms of gold, I've been signaling that a lot of the demand for gold, if you look on a kind of a session by session basis, has been coming in the overnight Asian sessions. And the idea is that a lot of this push into the retail ETFs has been by Chinese buyers, so Chinese retail demand for gold. Now, the fact that a lot of those markets are closed, could that be that overnight there's less demand for gold? And certainly at the moment, gold here just seems to be sort of fading a little bit. Again, there's a lot of bullish reasons to be bullish gold, sort of in a structural sense. But I'm just saying, could this just be a little bit of sort of a lack of energy and buying power in China, and gold just over the next few days could sort of come down a little bit. We also saw overnight silver coming down a lot, and also copper coming down very, very significantly here. So you see copper coming down. I'm just going to go out to the July contract here. But copper, again, coming down to sort of a Fibonacci sort of resistance here at the 38% level. So all of the metals coming off, especially the semi-industrial metals here, or the industrial metals. And part of that could be, as I say, some of the markets closed in China because structurally copper, doing quite a lot of research over the last 24 hours, which I'm not going to go into the details here, but there are reasons to believe there could be sort of a squeeze in the copper price. On the other hand, technically, I think it will face some resistance. But the point is here is that copper's down quite a lot overnight. And what I wanted to say as well is that overnight we had the Chinese some PMIs. So the official ones, so that's the official National Bureau of Statistics PMIs, were actually lower. So again, this is a bit the Trump's point and Besant's point is to be saying that the Chinese are going to start feeling a lot of pain from this lack of trade, this trade embargo. And in fact, it's going to be the Chinese who are going to crack. We shall see and pick up the phone. On the other hand, we had the Caixin, so the private survey of PMIs, which actually was a little bit more positive. So again, still a little bit too early to actually have a truer understanding of what's going on in terms of the impact on the Chinese domestic economy. But it's starting to look as though there are some sort of cracks there. And we had some comments also overnight from President Xi Jinping, who essentially said that I mean, again, without going into too many details, but there could be some stimulus and there would be need to sort of support the economy at a general level. So definitely, behind the scenes in China, the authorities there are watching the situation. And could they unleash some stimulus, especially, let's say, for the housing market? That would be another positive for copper. So it's going to be interesting to see if this fall in the industrial metals actually continues, or it's a bit of a one-off. So that's about it, guys. Just finally, oil. We had the API, the private survey numbers for inventory last night. You can see here oil is continuing to fall. And if you look at the API numbers, there was actually a build of almost 4 million barrels. There was 3.8 million barrels, so a significant build, which was much more than expected. I mean, there was a draw in gasoline, so that offset it a little bit. But the point is here is that, as I keep on trying to say, that with global uncertainty, or uncertainty about the global sort of economy and global trade, and an artificially suppressed market, which everyone understands this is artificially suppressed. Oil's just finding it hard to have a bid, and I do believe here you see it's kind of like a bear flag. It looks as though it might just want to maybe at least do sort of a test of this recent bottom. That could be a bottom there, but we could get down into the early 50s until and unless, of course, we get clarity about trade and Trump and the global economy. So that's that. Just finally, probably things like copper and oil also not being helped by, we did have a stronger US dollar. Let's have a look. Here's the dollar index. So you see, not hugely stronger, but just sort of hanging in there a little bit. Again, looking for some clarity. And I guess, as I say, we're going to have a lot of data in the next hour or so, an hour or two. And then, of course, we'll get, as I said, the earnings after the bell. So all of that coming together, and then non-farm payrolls on Friday, more earnings tomorrow. So I think the point is that the market has been pretty quiet for the last few days, and now pretty essentially, if there's positivity, that could be a push up for the stocks. Any negativity, it looks like it could be, another sort of round, sort of turn downwards. We will have to see. Okay, I'm going to leave it there, guys, because I want to prepare for all of this. I hope that was useful, and we'll keep the conversation going. Thank you.